Hello everyone and welcome to my class on investment management where we'll solve previous year VTU question paper and last couple of days I'm solving problems related to duration. So again on the continuation of the same thing, and today also we're going to solve a problem on duration. So duration plays very important role when we talk about bond arithmetic. So whenever we are trying to establish the relationship between the price of the bond with respect to the yield till maturity of the bond, we know that the price is inversely proportional to YTM. So whenever the YTM will increase, the price will decrease. Whenever the YTM will decrease, the price will increase. We know that relation. But if I ask you that if YTM change by 1 basis point, how much the price will change by? Okay, so then to solve that question, you need certain mathematical parameters. Either those mathematical parameters can be duration or either they can be convexity. To know more about durations and convexity, theoretical part of that, for that you can go through my previous videos on durations and convexity, and there you'll understand much more better way that the mathematical formula derivations, everything we have done in past. Whenever we say duration, whenever we say duration, logically the examiner should mention clearly what duration they are asking you. They are asking you macular duration or they are asking you modified duration. So whenever I say macular duration, the formula of macular duration is summation of T means time period into present value of cash flow. This cash flows in the case of bond arithmetic, your cash flows are either in the form of coupon or either it can be in the form of face value or redemption value divided by the price of the bond, divided by the price of the bond. That is basically called as macular duration. While whenever we say modified duration, when we say modified duration, what is modified duration? Modified duration is nothing but it is macular duration. It is macular duration. It is macular duration divided by 1 plus YTM. So that is called modified duration. So I hope you know this part. Okay, fine, everyone. Now, going further, we'll do both this calculation for you people. So, if you see in this problem, the coupon rate is 6%. The coupon rate is 6%. The face value is 1,000 rupees. Then they are making annual interest payment. So the payment is done annually, and it has 5 year to maturity. The bond, then 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 the bond. When you talk about bond, the bond is redeemed at 5% premium on maturity. So here many people will get confused. See, please understand one thing that what happens in the real market scenario. In the real market scenario, it can be the implication that that the pricing of the bond, what happens, the bond when it actually trade in the wholesale debt market or retail market, it is application of demand and supply. So because it can be applied over demand and supply, the people are buying or people are selling, maybe the issuer of this person bond, whoever person is trying to issue this bond, that person has came up with this bond with a face value called 1,000 rupees, with the face value with 1,000 rupees. So the company is liable to pay you 1,000 rupees when the bond will mature. But maybe because of XYZ reason, maybe they're not getting enough buyer for their bond. To make the bond attractive, what they have done, they have discussed, they have mentioned that this bond will be redemption, redemption value. So what they'll do, they mentioned that the bond, when after 5 year, when the company will buy back that bond from you, means when the bond will mature, then the company will not give you 1,000 rupees, which is given as the face value, because face value is means the value what they have committed to give you back once the instrument will get mature. But here they are just showing to become more aggressive so that people will buy their bond. So they're telling that they'll buy this bond at 5% on the 1,000 rupees. Redemption value, when we say redemption value and face value mean same thing. Redemption value and face value both mean same thing. whenever nothing is given as such about the market demand and supply for the debt instrument. Here they have mentioned clearly redemption. Redemption, redeemable. Redeemable means whenever it will get mature, it will get mature at 5% premium. 5% premium means, so the face value was 1000 rupees. The face value was 1000 rupees. It will get mature 5 extra on the 1000 rupees. Discount also, if they would have mentioned discount, then you would have subtracted it. Redemption value and face value both mean same thing. If nothing as such is given about the premium and discount of the debt instrument, because in this problem it is given, because in this problem it is given about the redemption value that redeemable at 5% premium, it means that after 5 year, when the company will give you the money, company will give you 5% extra on the face value. Okay, company was supposed to give you only 1000 rupees, but they will give you extra 5%, maybe just to make as a sweetener, maybe something as a bonanza or gift or whatever. I hope you are getting it. Just to attract more investor, they are telling that when they'll buy back the bond after 5 years, they'll buy back at 5% premium. I hope you got the logic. So coupon rate is 6%. The coupon rate is 6%. So the value of your coupon is equal to 6% of 1000. So the value of your coupon is 60 rupees. The value of the coupon is 60 rupees. Okay, then the time period of maturity, the the time period of maturity, the time period of maturity is 5 year. The time period of maturity is 5 year. The time period of maturity is 5 year. Okay, and this coupon is 6%, so they got coupon is 60 rupees. Mm-hmm. So 5 year is the maturity of the time period, and then the market interest rate, YTM. YTM is given to you as 8%. The YTM is given to you as 8%. So ill till maturity. I hope everyone knows what is YTM. Ill till maturity. That is the internal rate of return, the minimum return what you can expect on the debt instrument. Here it is given as 8% per annum. Very simple. So what you can do to solve this problem, so you can write the value. So you can write the value. Your values are 1, then you have 2, then 3, then 4, then 5, 5 year. Okay, then your future cash flow. What are your future cash flow? Your future cash flow is what, how much they're giving you coupon, 60 rupees, no? 60 rupees they'll give you every year. 60 rupees they'll give you every year. 60 rupees they'll give you every year, and then on fifth year, uh, the when the instrument will get mature, they'll give 60 plus 1050. That is your redemption value. So how much you will get? You will get 1110 rupees, no? You'll get 1110 rupees. Okay, everyone. So YTM is how much? Is YTM is I think is 8%. So YTM is 8%. YTM is 8%. Your YTM is 8%. Your YTM is 8%. So your YTM is 8%. Fine, everyone. So your YTM is 8%. So what you can do, you can find the present value of your cash flow. You can find the present value of your cash flow. So that would be 60 divided by 1 plus 8% to the power 1, means 60 divided by 1.08. Similarly, 60 divided by 1 plus 8% to the power 2, that is 60 divided by 1.08 whole square. Okay, then similarly 60 divided by 1 plus 8% to the power 3, and 60 divided by 1.08 to the power cube. Then 60 divided by 1 plus 8% to the power 4, means 60 divided by 1.08 to the power 4. Then here this is what, this is 1050 and plus 60, that is 1110. So this is 1110. So this is divided by 8%. So for 5 year, so this is 1110 divided by 1.08 to the power 5. I hope everyone understood this. So find the present value of all this. Find the present value of all this. Find the present value of all this. 60 divided by, so 60 divided by 1.08. 60 divided by 1.08, that is 55.555555. Okay, then this divide by 1.08 again, so this is 51.44032. Then this again divide by 1.08, that is 47.6299. Okay, again this is divide by, again this is divide by 1.08, that is 44.10179. Okay everyone, then 1110 divide by 1.08 to the power 5, that is 755, that is 755.44734. So this will give you the price of the bond, sum total. This will give you the price of the bond, the sum of this. Everyone please do this. I believe everyone has written down this. So the price of the bond, sum total of this. So the price of 954.175, 954.175. That is the price of the bond. So once you get this, now what you have to do for the duration, now what you have to do for the duration, because you want to find the duration. So what you have to do for the duration, you have to multiply, the t into present value of cash flow. You have to multiply the t into present value of your cash flow. So t into, so 55.11 into 1, 55.55 into 1 to 1, then 51.4044032 into 2, then 47.6299 into 3, then 44.10179 into 4, then 755.44734 into 5. So do this. Okay, so this if you do, you'll get 55.55, 55.55. Second one you'll get is 102.88, 102.8807. Third one you'll get is 142.8898. Fourth one you'll get is 176.176.4072. Then last one you'll get is 3777.237. And then sum of t into present value of your cash flow, that will be equal to 4254.97, 4254.97. Yogeshwari, it's coming 4254.97. Check again. So once you get this, so once you get this, okay. So once you get this, then the duration or means macular duration. So the macular duration of the bond, macular duration of the bond, macular duration of the bond that will be equal to that is equal to T into present value of cash flow divide by the price of bond divide by the price of bond. So that is equal to how much? That is equal to 4254.97 divided by 954.175. That will give you the macular duration of the bond. That is the macular duration of the bond. So once you get the macular duration of the bond, you want the modified duration. You want the modified duration. So the modified duration of the bond. The modified duration of the bond is equal to macular duration. Modified duration of the bond is equal to macular duration divided by the 1 plus YT. 4.4593 divided by 1 plus 8%. That is the modified duration of the bond. That is 4.4593 divided by 1.08. 4.1289. 4.1289. That is the modified duration of the bond. Okay, everyone. So I hope you understood the concept of duration. So duration altogether is very important topic whenever we talk about debt market. So normally, if when we talk about the relation between the price of the bond with respect to the YTM, so it was hypothetically believed to be straight line, as we thought it is a they are inversely proportional. So price of the bond with YTM, but in reality, it is not it's straight line. It is a convex line. So duration which basically measures the slope of the straight line, duration alone cannot help us to understand the percentage degree change in the price of bond uh, with respect to the percentage degree change in the YTM. So you need much more better hypothetical parameter which we called as a convexity. Okay, so it was being observed that the small change in YTM will bring the opposite change, the small opposite change in the price of the bond, but the larger change in YTM does not impact the price in much significant manner. So that it from that it can be understood that the price of the bond cannot be 100% inversely proportional. So that nature of that nature of curve that we can understand by second order differentiation of the price of the bond with respect to YTM, and that can be understandable by using the role of convexity. So if you want to know more about convexity, you can watch my previous videos on where on price of the bond with respect to durations and convexity, where I have explained all these concepts. step by step way. So I really suggest you all to go through that. So if you have understood everything, what all we have done so far till now, so it's time to say goodbye to all of you. Thank you everyone. God bless you. Take care. Bye.